Greetings, everyone. Welcome to Liberty Call. Today is Tuesday, May 23rd, 2023. Hope everybody's having a fantastical day out there. Not a great day in the markets. Looking across the screen here, lots and lots of red. So it looks like the bloodbath started overnight in Asia and continued to be a contagion all through Europe, and then same thing here in the United States. So, you know, looks like we're going to cover an article about the debt deal is still not happening, and how if the people in charge would just leave the markets alone, they'd probably self-correct and be okay. So, all right. Well, glad you're here. Thanks for watching Liberty Call. If it's your first time watching, please give me some thumbs up, likes, shares, subscribes, and follows, all that good stuff. I'd greatly appreciate it. And let's go and jump into the numbers for today. Dow Jones was down 0.69%, 231 points, closed at 33,055. S&P 500 was down 1.11%, closed at 4146. NASDAQ was down 1.26%, closed at 12,560. The VIX was up 7.73% today. It's back up to 1854. Canada was down 1.01%. Brazil was down 0.27%, and Mexico was down 0.63%. Go over to Europe. Germany was down 0.44%. UK was down 0.1%. France was down 1.33%. Netherlands was down 0.21%. Spain down 0.41%. Italy down 0.5%. Switzerland down 0.59%. And sole bright spot, Portugal was up 0.35%. Russian exchanges both in the green. The MOEX was up 0.32. The RTSI was up 0.21%. And in Asia overnight, the Nikkei in Japan was down 0.42%, Australia down 0.05%, New Zealand down 0.27%. In China, the Shanghai was down 1.52%, the Shenzhen Component down 1.03%, China 50 down 1.57%, DJ Shanghai down 1.42%, and the Hang Seng down 1.25%. Taiwan weighted was flat at up 0.04% for the day. So, trading day 523 was not real excellent, unfortunately. So, now for a lot of you folks out there who've been hoping that the markets are going to turn around any day now, you're probably being lulled into a false sense of security and you're going to get kicked in the balls. But anyways, all right, let's jump over to the market recap. S&P 500 slips as debt ceiling impasse weighs. On Tuesday, the S&P 500 experienced a decline as concerns over a potential U.S. default grew following the end of the debt ceiling talks without a resolution. Lawmakers were unable to reach an agreement on raising the government's debt ceiling just days before the June 1st deadline. Dun, dun, dun. Highlighted by Treasury Secretary Janet Yellen, the dumbest human on the planet, as a potential default risk. Oh no. Despite the lack of progress, both President Joe Biden and House about reaching a deal to avoid default. However, the ongoing debate around the issue is expected to increase volatility in fixed income and equity markets, according to Wells Fargo. I mean, I think the big thing is that the Republicans want to cut spending, and the Democrats, they've never want to cut spending. So I hope there's a default. Personally, I'd like to see everything just fall apart. Technology stocks were among the worst performers, pressured by an increase in Treasury yields. Companies like Apple, Alphabet, and Microsoft led the downward trend. Retailers also faced downward pressure, with Lowe's companies reporting lower first quarter sales and revising its full year outlook due to a weaker consumer and lower lumber prices. However, Dick's Sporting Goods exceeded Wall Street expectations in its first quarter results, defying the overall downward trend in the retail sector. Regional banks saw gains building on the momentum from the previous day. PacWest Bancorp experienced an 8% increase after announcing a $2.6 billion loan sale to bolster its financial position. Other banks, including Citizens Financial, Zions Bancorp, and KeyCorp, also performed well. Dallas Federal Reserve President Lori Logan emphasized the availability of the central bank's liquidity backstop whenever needed by banks. These remarks followed St. Louis Federal Reserve President James Bullard's statement that he anticipates 2 additional rate hikes to counter inflation. However, despite these hawkish comments, approximately 88% of traders still believe that the Fed will pause in June, according to Investing.com's Fed Rate Monitor tool. In economic news, services activity in April exceeded expectations and reached a 12-month high, raising concerns about potential inflationary pressures. In other developments, Yelp saw a surge of over 6% after Activist investor TCS Capital Management acquired a stake in the service recommendation company and pushed for strategic options, including a potential sale. Additionally, Virgin Orbit sold its assets in a bankruptcy auction to Rocket Lab USA Inc., Strato Launch, and Vast Launcher. All right, so that was the recap for the day. Let's dive on over to a little more in depth on the debt ceiling. No signs of progress as White House and Republicans end more debt ceiling talks. All right, let's see what we got here. Debt ceiling talks between representatives of Joe Biden and congressional Republicans ended without progress on Tuesday as the deadline to raise the government's borrowing limit approached. The two parties remain deeply divided on how to address the federal deficit. It's not a deficit, it's a debt. With Democrats advocating for increased taxes on the wealthy and businesses while Republicans push for spending cuts. Negotiators from the White House and Republican counterparts met for about 2 hours, but left without making substantive comments to the media. Treasury Secretary Janet Yellen has warned that the federal government could face difficulties in paying its bills as early as June 1st, leading to a default that would negatively impact the U.S. economy and increase borrowing costs. Again, just quit spending money. I mean, seriously. I mean, the assets at the Fed are rolling off every month, and I think it's like $75 or $95 billion a month are rolling off their balance sheet. I mean, that should free up money right there, but no one seems to talk about that. I don't know. Where were we? A Republican negotiator, Representative Garrett Graves, expressed pessimism about the talks, noting the lack of progress and Democrats' resistance to reducing spending. Despite the challenges, both Biden and the House Majority Leader Kevin McCarthy expressed the need for bipartisan compromise and expressed their commitment to finding a way forward. The lack of clear progress in negotiations continued to weigh on Wall Street, with the U.S. stock indexes opening lower on Tuesday and global markets remaining on edge. Biden and Democrats proposed freezing spending in the 2024 fiscal year at the levels of 2023, arguing that it would represent a spending cut due to budget adjustments not matching inflation. Republicans reject this idea and advocate for spending cuts instead. Yeah, so we're just not going to spend any more. So that's a spending cut. Now, it's kind of the logic my mother used to have with going shopping. It was on sale. I saved 50%, but you spent $1,000. So you didn't save any money. Biden aims to reduce the deficit by raising taxes on the wealthy and closing loop. How much more can you raise taxes on the wealthy? I mean, the top 10% of income earners are paying all the tax, or really top 20%. But I mean, if you're making like $75,000 or $80,000, you're in that category. I mean, everyone, you and above are paying all the taxes. Everyone else below you is not paying anything. So keep it clean. All right. Where was I? Biden aims to reduce the deficit by closing. Okay, yeah. The negotiation process between Biden and McCarthy would require approval from their respective caucuses in Congress. Even if a deal is reached, it could take about a week to pass through both House and the Senate before it can be signed into law by Biden. The approaching deadline has sparked debate among members of the Republican House Freedom Caucus, with some expressing skepticism about the June 1st deadline set by Treasury Secretary Janet Yellen. However, top House Democrat Hakeem Jeffries reaffirmed the validity of the June 1st deadline. Yeah, because, I mean, obviously a congressperson is so honest, emphasizing Yellen's continued warnings. Failure to raise the debt ceiling would result in the United States potentially defaulting on its obligations, leading to a recession, causing turmoil in the global financial markets. Bipartisan support is necessary for any agreement to raise the limit, and the current breakdown in negotiations highlights the challenges ahead. Despite the impasse, the two sides have found common ground on certain issues, such as permit reform for energy projects. Wow, big stuff. However, leaders caution that nothing has been agreed upon yet, and a sense of urgency is needed to address the situation. Yeah. Kick the can. And then, when finally everything's falling apart. Yeah, I mean, what they'll do is they will close like the National Mall. They'll close like the parks, stuff like that, just to, be a jerk to the American people. And I mean, personally, I don't care. But I mean, most people work at those places are on adult daycare jobs anyways. So, all right. One last article here comes from Mises Wire. It's titled How Markets Self-Corrected During the 1819 and 1919 through 2021 Recessions, written by Vibhu Vikramaditya. Sorry, Vibu, if I messed up your name. So let's go ahead and read through what my summary here and see what he has to say. The United States is facing a looming threat of deep recession characterized by bank failures, rising unemployment claims, and declining retail sales. In such a scenario, the Federal Reserve and the U.S. government responsible for managing the economy face. Actually, I don't know where he would get that. The Constitution doesn't say anything about managing the economy. That's just something that they've taken on beyond their jurisdiction. Where was I? Face a monumental task in determining how to respond. The question arises, will they resort to interventionist measures like rapid interest rate cuts, quantitative easing, and excessive government spending to mitigate the recession? While these measures aim to cushion the economic downturn, they distort market signals, misallocate resources, and perpetuate unsustainable structures, hindering the market's self-corrective mechanisms. Allowing recessions to run their course enables organic recovery. The non-interventionist approach recognizes that short-term pain is necessary for long-term economic health. It acknowledges that failure and liquidation of businesses, firms, and banks are integral to achieving sustainable economic growth. In this approach, the focus shifts to inherent self-corrective mechanisms within the market. Historical evidence, such as the recessions of 1819 and 1919 through 1921, demonstrate that allowing these natural healing processes to unfold has catalyzed a return to prosperity. The non-interventionist approach requires patience and faith in the market's ability to rebalance and recover. It involves deflating artificially inflated asset prices and liquidating bad investments, which frees up capital for utilization in profitable sectors, and thus initiating the recovery process. Critics of non-interventionist approach, including Keynesian and monetarist economists, argue for extending QE, increasing government spending, and reduced interest rates. They contend that liquidation can only worsen a recession by reducing demand and causing unemployment. Keynes, for instance, believes that stimulating demand through lower interest rates and government spending allows for more gradual correction of malinvestments. Monetarists, represented by economists like Milton Friedman, also oppose liquidation. They argue that maintaining stability in the money supply can prevent severe recessions and offer a better cure than potentially destructive liquidation process. However, these measures risk prolonging the adjustment process and creating greater economic instability in the long run. Examining the recessions of 1819 and 1919 provides insights into the efficacy of non-interventionist policies. During the 1919 through 1921 recession, the Federal Reserve's tight monetary policy, characterized by high interest rates and contraction of the money supply, contributed to the severity of the recession and a high rate of business liquidations. Nevertheless, the economy experienced a swift recovery as liquidation facilitated the reallocation of resources and the adjustment of post-war post-war conditions. Similarly, the Panic of 1819, the first major peacetime economic crisis in the U.S., saw a contraction in the money supply, sharp decreases in prices. Deflation played a crucial role in restoring economic balance by lowering the cost of goods and stimulating demand. Although the government did not actively intervene, the economy began to rebound relatively quickly. These historical episodes emphasize the importance of understanding the market's self-corrective nature and exercising patience. By allowing the process of deflation and liquidation to unfold, capital and labor can be reallocated to more productive uses, leading to sustainable economic recovery. Therefore, economic policies should resist the temptation to over-intervene and instead allow the market's invisible hand to orchestrate the recovery. This approach fosters a more resilient and sustainable economic framework capable of weathering future economic storms. And, we can just look back at the last 20 years and see what government intervention has done. We had the dot-com bust, and then after that, there was interest rates went down, and then we had the housing bust because the people in the housing industry and the banks figured, hey, we could we could offer loans to all these people who can't afford to pay them back. We can then bundle up these loans into tranches and then sell them as investment products out there as safe. And we got our rating agencies to slap a AAA rating on everything and say, yeah, everything's fine. They're good. They're totally safe. And then we saw what happened when the economy slowed down in 2007 and 8. those are the first people to default, simply because people with bad credit are typically the ones to stop paying their bills first. And, then we had the housing collapse. And then, then just the last 3 years, we can see what, obscene amounts of stimulus and money creation and, government intervention. And now we can see the consequences of those actions just a couple of years later. I mean, the inflation rate has gone through the roof. I mean, things, costs of goods have, increased, to a tremendous amount. I mean, cars, homes, things like that, food, energy prices. I'd like to see them go down a little bit more, but, in my opinion, the government just makes things worse. This article, outlines that. But hey, we're just libertarians. What do we know? Austrian economics. No one seems to really want to pay attention to it. They'd rather just take the easy way out and have comforting lies and say, yeah, it's all going to be fine. Here, take your cash and spend it on whatever you want. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.